In the great game of global currency battles, there is no more pivotal battleground than the yen-dollar exchange rate. For decades now, Japan and the United States have skirmished across this field, maneuvering to gain advantages for their exporters and shape international monetary conditions to their liking. Until recently, the winds seemed to favor America. The yen had weakened to a 24-year low against the muscular greenback, pushed down by the Bank of Japan's insistence on rock-bottom interest rates and profligate money printing even as the Federal Reserve aggressively hiked rates. By late October, $1 bought a mind-boggling 151 yen. But then, in a surprise offensive, Japan's finance ministry unsheathed its most powerful weapon, direct, unilateral intervention into the foreign exchange markets. Over 2 trading sessions in late April and early May, Tokyo effectively flooded the battlefield with a record 9.8 trillion yen, $62.7 billion, all aimed at shoring up its beleaguered currency. The impact was swift and unmistakable. Within hours, the yen surged over 5% against the dollar from intraday lows, in the largest upward move in nearly a quarter century. For weeks afterward, the dollar has struggled to break much above 135 yen, a line in the sand vigorously defended by Japan's monetary mandarins. On Tuesday, Finance Minister Shinichi Suzuki publicly hailed the intervention as a clear success, if a costly one. "We believe that it had a certain effect," he declared, in the classic understated bravado of the Japanese technocrat. Make no mistake, this was no mere pedantic exercise, but a calculated strike at the very core of America's financial hegemony. For the yen's freefall, a byproduct of endless stimulus, threatened to upend the delicate equilibrium underpinning our modern system of fiat monies. A drastically devalued currency may seem an enticing way to resuscitate exports for an aging economic power like Japan. But the risks of a tit-for-tat cycle of competitive devaluations, beggar-thy-neighbor policies, and ultimately a collapse of monetary order are far too grave. That is the abyss the world's financial guardians must avoid at all costs. So even as the Bank of Japan refused to raise borrowing costs, its political principles likely felt compelled to draw a line in the sand. A yen in freefall threatened not just Japan's export machine, but its very identity as a bastion of economic probity and monetary seriousness. The Japanese strike was an unmistakable shot across the bow of the Federal Reserve and America's de facto dollar dominion. For all the talk of a Japanification of the West, this was Japan loudly resisting its own irrelevance, demanding a seat at the top table of monetary powers. To some, it may seem odd to fixate on dull foreign exchange games amidst a world afire, stagflation looming, geopolitical chaos erupting, and a steady drumbeat of existential threats from climate change to AI anxiety. Yet the choreography of global capital flows, with all its weaponized exchange rates and shadow currency wars, may be among the most pivotal dramas of our age. For it is in the great monetary tussle, more than the realm of trade or military brinksmanship, where the deepest shape of economic and political power is continuously being contested and defined. In this high-stakes match, Japan has defiantly proven it won't go gently into that good night of economic insignificance. Even if its victory is fleeting, even if the forces of demography and stagnation ultimately grind down the Japanese juggernaut, the samurai warriors of the Ministry of Finance have scored a psychological win. They have reminded us, with trillion-yen artillery blasts, that the economic order we inhabit today is more contingent, and more fiercely guarded, than we often realize.